Hello, welcome to Let's Talk Taxes Tuesday with your host, myself, Nafisa Manera. And yes, this is produced by About Her Business 360 Network, where we are all about the business 360. Yes, so let's jump right into Let's Talk Taxes. I know y'all know it's tax season, right? So there's a lot of things going on, but really, it is a lot of drama and moving parts that's going on right now since President Trump and Elon Musk have gone on this journey, should I say, have tried to ignite this journey to cut taxes because that was one of the pillars that President Trump ran on was being able to have all these tax cuts to the middle classes. So they jump right in and start trying to do it. So we're going to talk about the major initiatives which may or may not affect you, right? We're going to talk about it on Let's Talk Taxes on Tuesday today. We're going to talk about it. So before I get into it, though, I want to let you know that we want to keep certain things in mind when we're talking about taxes. I know this whole thing about taxes and what people are paying and how much they're paying and all that can kind of sometimes get us riled up emotionally. But what we have to keep in mind when they're talking about taxes, because I want to make sure that they're not just trying to swing you emotionally in one direction or the other, that you're paying attention to the numbers and you're paying attention to the macroeconomic aspects of taxes as well as the microeconomic. You're trying to pay attention to the big picture of what's going on as well as the details because we don't want to get lost in the details that we lose sight on what the big picture is. And when you're talking about taxes, basically what you're talking about is what? It's a forced contribution. A first contribution obligation that every citizen and businesses are subjected to. If you're a U.S. citizen, right? If you're a U.S. citizen, the United States taxes all your income from whatever source, no matter where it was made, whether it was made here in the United States, whether it's made in Japan, whether it's made in Ghana, the U.S. government don't care. If you're a U.S. citizen, we're going to tax all your income unless we have provided in our tax code that it is specifically excluded. Right? So keep in mind, that's what the big thing is. And also keep in mind that this whole business about taxes, at the end of the day, we're talking about what the government collects and operates off of, right? Because the government is not a business, it's not technically a business. So they're not selling anything in order to generate income, in order to generate any money, right? The only way that the government gets money is by taxing your income, services, uh, businesses, products by putting a tax on it. That's how they get inflows into their bucket. Inflows into the government bucket comes from us being taxed on the income that we make, businesses being taxed internationally. The whole that you're hearing a lot in the media talking about tariffs. Well, all tariffs are a tax. It's just an internet. I like to call it an international tax, right? It's a tax dealing with goods, the exchange of goods and services between countries. So that's why it's called a tariff. But at the end of the day, it's just an international tax. Okay. It's just a way for the government to get what? Inflows into their bucket. Right? So that they can then do what? Turn around and put outflows into what? To whatever they want to give an outflow to, whether it's to grants, whether it's to agencies, to all the departments and stuff that they run and all the people that they're hiring, all the infrastructure that's being built, money that's given for these infrastructure projects, all the money that's being being given to run education, all of that is coming out of the bucket. So you got taxes flowing in to the bucket, and then the government is giving outflows out of the bucket. So keep that big picture in mind. Anytime that you hear somebody talking about a tax cut, meaning that you're going to stop the flow of some money going into the bucket, that means you're going to be stopping some flow from what's coming out of the bucket, right? Because unlike a regular business where you want to have more money coming in than you're spending, the government likes to have a budget, and they like their budget to balance, which means that, hey, whatever I have over here that came in is exactly how much went out. And we all know that the current U.S. government is operating at a deficit, right? And all a deficit means is that we spending more than we bringing in. So we spending more than we bringing in, and that's why every few months you hear about, oh, we got to raise the debt ceiling. We got to raise the debt ceiling. In other words, they need some more credit. Now, this is no different than in your own household, right? In your own household, you have money coming in and you got money going out for expenses. If you have more going out, if you're spending more than you bringing in, you do what? Grab them credit cards, don't you? And then when those credit cards get to the limit and you still spending more than you bringing in, what you do? You call the credit company and ask them if they can raise your limit. That's the same thing that the government is doing. It's just doing it at a macro level, a big picture level. So that's what's happening. And because we keep wanting to raise the limit, this is not good. Same thing, if you you keep spending more money in your individual house, guess what? At some point, you got to say, we got to make some changes. So all these changes that they're making, even though they may be painful, trying to cut people's jobs and cut programs and all this other kind of stuff, we could talk about, excuse me, we could talk about whether they should cut this program or that program. But the bottom line is there needs to be cuts, because you can't keep spending more than you're bringing in. You can't keep spending more than you bring it in. So at the end of the day, this is where we are. Okay. And just to give you a little perspective, because I like to look at the numbers, right? Just to give you a little perspective, right now, the federal government is running in a negative for this fiscal year. The government's year runs from October through September 30th. So as of October 2024, which was only a few months ago, to right now, we are running at a deficit, $840 billion deficit already. And let me see, how many months? October, November, December, January, February. We're in the 5th month, and already we're over the limit by $840 billion. And just to give you a little perspective, right? Last year this time, we were only over budget, 532. So we went from 532 just at this point in time, 4 or 5 months in. Last year, we were $532 billion over budget. Now we're $840 billion over budget. Can't you see we moving in the wrong direction? And some stuff just got to be cut. Because you can't keep doing this. Right? All right. So let's get into it. Let's look at these tax cuts, because President Trump did promise the middle class that he was gonna have all these nice tax cuts or whatever, so that we can have more money in our pocket or whatever. Let's look at the top ones that may affect a lot of Americans, a majority of Americans. Okay. So the first one is no tax on tips. These are not what the law is currently. This is what he wants to happen. right? And he has charged Congress with coming up with a budget where these initiatives that I'm about to tell you about have been taken into consideration. So this is just letting you know what he wants to do and what he has charged Congress with doing. Now, rather what they come out with, we don't know. I'm gonna let you know that in the coming weeks. But let me tell you what it is that he has charged Congress in terms of what he wants to happen. Number one is no tax on tips. Anybody that's getting tip income, he doesn't want it to be any taxes on those tips, right? Okay, that sounds good. But again, if we're going to cut what's going into the budget, you need to go, you don't have to cut them expenses that's coming out the budget too, right? So if he says no tax on tips, that means they're estimating they're going to have about $118 billion they're not going to get over the next 10 years. That's $118 billion, which is not going to be not going to flow inside the bucket to be distributed. Okay? So we already at a deficit. Now we're going to take more money out the bucket. Okay? But this is what he wants to do. Number two, no tax on Social Security. As it stands right now, only I think about 50%, give or take, don't quote me exactly on that, of people are not taxed on Social Security, right? And that's going to depend on their income. A lot of times, depending on their age and whether they have like another job or other income, that Social Security income may or may not be taxed. But what President Trump wants to do is have no tax on Social Security benefits at all. Now, how much is that going to cost? How much is that going to take out of the bucket over the next 10 years? Well, that's going to take out of the bucket. Let me see what I have here on my notes. I have here on my notes. That's going to take out of the bucket $1.8 trillion over the next 10 years. So you got, if that particular initiative is approved, it's going to take out of the bucket $1.8 trillion. We're not moving in the right direction. Y'all can see that mathematically, we're not moving in the right direction. Okay. Then the number three initiative is no tax on overtime pay. Now, all of this sounds good, right? And it sounds like, oh, yeah, that would benefit us, right? Okay, that's good. I mean, I'm all for it. Again, this will take out of the bucket $1.3 trillion. So far, we got three initiatives, and all of them are taking money out the bucket. I haven't told you about any initiatives that are going to put some money back in the bucket yet. Those are initiatives that's taking money out the bucket. Okay. Now, the fourth thing is in 2017, it was a big tax act that passed. And matter of fact, at the time, it was one of the largest tax acts that had ever passed since Ronald Reagan, right? That was in 2017. It was a lot of tax cuts that happened during that particular year, a lot of initiatives. Now, those tax cuts, a lot of those tax cuts were temporary. And temporary only supposed to be for like 5 years. So they are set to expire. A lot of those tax cuts that people have been benefiting from over the last couple years will be expiring, which means that we're going to go back to pre-2017 in terms of whatever initiatives they had in place at that time. Right. And I'm gonna talk to you. I'm just gonna touch on a little bit on what those tax cuts are that are going to be expiring at the end of 2025 that Trump wants to renew. Because a lot of those benefit small businesses. So I'm gonna tell you a little bit about that at the end. I just want to kind of get through these right quick. The fifth initiative that President Trump wants to initiate in the tax code is that he wants to adjust what they call the SALT cap. And SALT stands for state and local taxes. Now, for some of you that have had homes for a while and were itemizing your deductions before 2017, you were allowed to take yeah, your state and local taxes as a deduction when you itemize on the Schedule A, right? You were allowed to take that. But then what happened in 2017, they put a cap on it. They said, no, you can't take any more than $10,000. Well, if you're in a low cost tax state like Georgia or a no tax state like Florida, for example, this may not affect you that much. But if you're in a high tax state like New York, like California, like Illinois, you're going to have way more than $10,000 in state and local taxes, but you're capped at $10,000. Meaning you can't take, if you got state and local taxes totaling $30,000, you can't take that full 30,000. You can only take 10. So what Trump wants to do, he either wants to eliminate the limit on that. In other words, make it unlimited like it was before, or he wants to raise the limit to $20,000 or $30,000. So who knows what Congress is going to come up with, whether they're going to decide to eliminate the cap altogether, right? And if they eliminate the cap altogether, that means guess what? You're taking out of the bucket another $1.2 trillion over 10 years. Okay? The other number six thing is that Trump wants to do, and this will actually add money, put money into the bucket, is he wants to eliminate what's called the carry interest loophole. Now, most of you all don't know about this, and most of you all are not going to be affected by this because this mostly applies to like investment bankers and those who have maybe REITs and that type of thing, right? They are usually compensated through what's called carried interest. And this was a special loophole just for them. Because unlike, let's say, you or me or a lot of other people, when we're compensated, we're usually compensated by wages, right? Based upon our salary. And our salary is usually taxed at what they call ordinary income rates, right? It's not taxed at capital gains rates, which can be lower. Capital gains is when you sell assets. So when you sell a house or when you sell a stock or any type of asset like that, your rate is going to be a little bit different. So this carry interest loophole was allowing a lot of these investment bankers or hedge funds, was allowing a lot of these hedge fund founders and owners to basically be taxed at a capital gains rate, which is lower. So, for example, if they made $5 million and they were taxed like me and you on ordinary income, then they would be taxed at 37% because that's the highest tax rate. They would be taxed at 37%. But under this carried interest loophole, they were only taxed at 20% because, as I say, maybe 20% because it's at capital gains rate, which is a little bit lower. So Trump wants to eliminate this loophole. And by eliminating this loophole, more people will be taxed, more money would be taxed, which means what? You're going to have more money going into the bucket. But this, because it only affects a very small percentage of people and a small percentage of any kind of money, we're not talking about a lot of money here. Okay, we're not talking about, I think I got, let me see what we got, 40, 13 billion over 10 years compared to trillions that I just told you we was taking out of the bucket. 13 billion, and that's not really a lot. But again, it'd be 13 billion you can put back into the bucket if Congress decides to close up this particular carry interest loophole. Now, this is an interesting one that Trump wants to do. He says he wants to basically stop rewarding billionaire sports owners because they are paying a lower percentage of tax than the regular person in the middle class. And the reason why they get to pay a lower percentage of their income in taxes is because of what? There is a loophole for them too. right? They had some friends in Congress writing a special loophole for them a few years ago. And so they were getting special write-offs just for sports teams owners, right? And what this is like they were basically being able to write off their investment. So, like what you might call player contracts or rosters or what you call intangible assets. You know, these are assets you can't really touch, right? They were basically being able to write those off over 15 years, just like you have depreciation, right? You have a car or a lot of people who have real estate, right? You write off, you depreciate part of that real estate over a certain number of years, right? And that's able to reduce your income. Well, this kind of works like that. It's basically amortization, is what they call it. But it was only available for sports teams owners. It's not available for anybody else. So it basically allowed them to take a deduction against their income for something that other people aren't able to take this deduction for. So President Trump says, you know what? I want to close that gap. And this a lot of times relate to, let me give you a quick example how this might come into play. You might have, let's say, what's the guy's name that's on Shark Tank and also owns a sports team, Dallas Mavericks. Oh my God, I can't believe his name escapes me right now. But anyway, let's say you have him who owns the Dallas Mavericks, right? And then let's say you have somebody that works at the stadium. They may earn, I don't know, $40,000, $50,000 a year. Their tax rate, their tax rate as a percentage might be about 14%. Okay, let's just say her name is Sally. Sally, who works at the stadium, earns about $40,000 or $50,000. Her tax rate might be 14%. So she's paying 14% of her income into taxes. Okay. Then you take somebody like, let's say, LeBron James, right? Of course, we know he earns millions and millions and millions of dollars. I don't know, maybe 100, maybe 200 million. Okay. And his tax rate is 35%. The reason why his tax rate is so high is because most like professional players, professional athletes, they're W-2 employees. Just like you or I may be W-2 employees and we get paid a salary. These players, they get paid a salary as well. They're W-2 employees, so they get taxed at the highest rate, which is usually around 35 to 37%. So you got Sally that's getting taxed at 14% of her income. LeBron James getting taxed at 35% of his income. And then if you take I like the guy too, and I can't think of his name, that owns the Dallas Mavericks. And actually, the other guy that made his money off of Apple, Steve Ballmer, owns the Clippers, right? Yeah, he owns the Clippers. Let's just take him for example, since I remember his name. He might only be paying 11 or 12% of his income in taxes because of this sports owners loophole. So Trump basically wants to get rid of that, right? So that these owners are paying more in taxes in terms of a percentage and they're paying their fair share. Okay. Now, the other thing in taxes is the tariffs. Now, what's happening with the tariffs? The latest executive order for the tariffs, what President Trump basically said with this, remember I said that all tariffs are international tax. It's a tax that's going to be happening between companies, between different countries, right? So what Trump just did in a recent executive order for tariffs, all he's basically saying is whatever country trades with us, we're going to charge tariffs and we're going to charge the same tariffs that you charge us. So if China applies a 5% tariffs on US goods that's shipped to China, then the US is going to apply a 5% tariffs on Chinese goods that's shipped to the US. That's basically what the executive order. So they want to give parity. They want to make sure they're giving parity right there, right? So whatever, same thing with Japan, same thing with um, France, right? Any country that trades with the United States, whatever tariff or tax they put on our goods, we're going to put the same percentage of tax or tariffs on their goods. Seems fair to me. It'd be interesting to see how it all plays out, right? But this, and understand that I'm giving to you very simple, right? And only reason I'm letting you know this is because number one, I don't want you to get pulled to emotionally and all the hype and excitement about these particular initiatives that President Trump wants to enact, because it's actually Congress that has to write these laws into place in order for this to take place, which they are currently working on. And I'm going to let you know when it passed, if it passed, for you to be concerned about it for next year, for you to be able to plan more appropriately for your situation for this year and next year. Okay. But right now, I'm just kind of letting you know generally what's going on there. And also, another thing that President Trump wants to do. Remember, I told you about the 2017 um, Jobs Act, which was one of the biggest tax cuts and jobs act that took place since Ronald Reagan. Well, also as a part of that particular act, they lowered the tax rate. So what it is right now is you can get taxed at 10% all the way to 37%. Most Americans are going to be Most middle income Americans are going to be in that 10 to 15 to 20% range. Okay. But that is set to expire again at the end of 2025. And so what Trump wants to do is basically renew and extend that particular thing, because if not, the rates will go back to what they were before, which the highest tax rate was 37%, and most Americans fell within the 15 to 25% bracket in terms of their income. Okay, so that's just something to keep in mind as we go on and we move on. So I don't want to hold you too long, but I did want to tell you about those particular initiatives. And also, I wanted to tell you specifically about the tax cuts that President Trump wants to renew that will affect businesses. They keep your eyes on this in terms of small businesses. Number one is going to be the bonus depreciation. You know, a lot of people got excited about the bonus depreciation. And basically all that did was it allowed you to write off your costs of your equipment quicker. So for example, if you bought restaurant equipment and you spent $60,000 on your restaurant equipment, instead of you depreciating it, in other words, taking a deduction for that cost, let's say over 10 years or over 7 years, you will be able to take 100% of that deduction in the year that you purchased that particular equipment. So you'll be able to take that $60,000 deduction right off the bat and use that against your income. That's what bonus depreciation did. But what happened was they had a phase in to reduce. So first it was you could take 100%. Then it said, no, okay, you only could take 80%. And then it was a phase in saying now, I think for 2024, you can only take 60%. 2025, 40%. So what Trump wants to do, he wants to basically renew it and say, oh no, let's go back up to 100% so people can start getting deduction, 100% deduction. In other words, you get your money back faster. At the end of the day, that's all we're really talking about. How fast can you get your money back? Get the benefit of your money back. And the beautiful thing about the bonus depreciation, because they have something similar like this, a similar deduction like this, which is called a Section 179 deduction. And keep in mind, anybody that owns a business, for any equipment that you buy, okay, whether you're talking about laptop, if you own a restaurant equipment, a lot of people use this to buy cars that they use in their business, right? So if they bought that Cadillac or whatever for, you know, the sports version for 75,000, or the new Lexus for 75,000, for example, right? They would be able to take 100% of that deduction, no matter what. And if their bottom line ended up being a loss, they would just be able to carry that loss forward for 20 years, right? But under the Section 179 deduction, you can still take, as long as it qualifies, you can still take a deduction, but you were limited to the income that you earned from that business. So if you earned $100,000 from that business, but you went out here and got you a Lamborghini for $250,000 and you use it in your business, well, 100 minus $250,000, you had a loss for $150,000. They would not let you take that full $250,000. Okay. I think what I'm gonna do next time that I'm am explaining a lot of things with numbers, maybe I'll get my whiteboard and I'll write it down, and it'll be easier for some of people to follow. Because I know a lot of times I'm a visual person too, and that might help people understand. Because I do want people to understand. A lot of people are business owners. A lot of people got side hustles. You might be a real estate agent. You might sell insurance on the side. You might have all different types of side hustles that people have nowadays. And I want people to be aware of these particular deductions and where we are moving in terms of allowing more of these deductions, or they're going to be eliminating some of the deductions, so that you can be aware, so that you're not paying more in taxes than you need to pay. Okay. Another one of those renewable deductions was let's see what I got here. They call the Section 199 deduction. All this was at the end of the day was, again, this is for business owners. If you had business income, it was allowing you a 20% deduction against your other income, right? And Trump wants to renew this deduction because it will go away. It will expire if he doesn't renew this deduction, okay? Another thing that Trump wants to do is some of this may not apply to you, but he wants to renew the employer credit for family leave. A lot of companies nowadays, they offer family leave, and even some of the small businesses that offer family leave. So this particular credit was kind of like an incentive for smaller businesses to offer family leave. This is basically giving them a credit. If you had a worker that, let's say, that went on maternity leave or whatever, and you wanted to be able to pay her some wages, as long as you paid her at least 50% of her wages, you were able to be eligible for this particular credit, right? So again, he wants to renew that credit so that employers are able to do that, and just encourages small businesses to institute the family leave benefits into their particular operations. And then the last thing that I want to highlight is, in terms of affecting small businesses, is the opportunity zone, qualified opportunity zone monies and credits. Now, what this act originally did, this particular provision originally did, it allowed in different states, all states had identified some areas that are called opportunity zones. And so if you were a business or you were an individual that, let's say you sold some of your stock, right? And you got capital gains. If you use that money to invest in any of these opportunity zones, then you would not have to pay capital gains tax. It basically was deferred. It was deferred. If you invest in it, was trying to encourage people to invest in these opportunity zones. So what happens is your tax would be deferred, and if you stayed in that investment for 10 years, then your tax would basically be forgiven. So Trump wants to renew this to, again, encourage more investment in these opportunity zones, right? So that people are able to invest in these opportunity zones. And it's a win-win too for both people, because, if I want to sell this particular building or that particular building, this particular real estate to be able to invest in downtown Atlanta or on some investments on the west side that are in opportunity zones. I don't want to have to pay tax on that, right? To then turn around and put that same money in a new investment. So this allows that you do that, even though there are some different real estate, I won't say tricks, but there are some other real estate things you can do to defer taxes on that. But hey, if you're going to invest in opportunity zone, you don't have to go through the expense of structuring your real estate transaction that way. Okay. And let me know if you want me to go in detail further on some of these particular initiatives. As I said before, I will be keeping you abreast on where Congress is on approving any of these initiatives, whether they're going to approve them in the way that President Trump initially laid them down, or they're going to make some adjustments to it, or how they're actually going to do it. Because at the end of the day, they got to find the money to pay for all these tax cuts. You can't take all this money out the bucket and then spend on the same level as before, right? That's just common sense when we think about our own households. I work 3 jobs. I can't stop working 2 jobs and now I only got one job, one income coming in, but I'm still spending it the same as if I had 3. That doesn't work, right? So it has to be some adjustments to take place. But it's going to be interesting to see how that all plays out, especially considering we're already operating at a deficit. We're already over budget, and we only 4 or 5 months in. So that's going to be interesting. But I hope this was helpful. I hope I was able to shed some light and a little bit of understanding on these various tax cuts that President Trump wants to initiate, and he wants Congress to work on and pass through, because we're going to be keeping our eye on that. And I'm glad that you joined me today for Let's Talk Taxes Tuesday. We got so many things that we're going to be talking about in the next coming weeks. So I'm just excited for you all. And again, put it in the comments if there is a particular tax topic that you want clarification on, that you want to dive into, some questions that you have. Let us know, because we are here to serve you, and we are here to try to make it clear to you when it comes to taxes, because of course it could be complicated, but I like to try to translate it into everyday language that anybody can understand. Okay, so go ahead and shoot us in a comment any questions that you might have. And thank you for joining me, Nafisa Manira, today on Let's Talk Taxes Tuesday, sponsored by About Her Business 360 Network. I'll see you next time, and I hope you have a prosperous rest of your week. Bye.